U.S. milk production and components continue to see year-over-year growth, a bumper crop for corn, and insights on cattle markets and dairy markets. Stick around for all this and more on this August monthly market update from HighGround Dairy here on the Uplevel Dairy Podcast. Information shared in this podcast is for educational purposes and is not a solicitation to buy or sell commodities. Opinions expressed are current as of August 18th at 1 p.m. Central Standard Time and only represent the views of the speaker and not those of HighGround Trading unless otherwise expressly noted. This episode is brought to you by HighGround Dairy. HighGround Dairy provides global dairy market intelligence, insurance services, futures and options brokerage, and advisory programs to a diverse range of dairy market participants throughout the supply chain. Curtis, welcome back to the Uplevel Dairy Podcast. What's been going on in the last months in the market?
We say a lot in the trade world of summer doldrums of things tend to slow down in the summer months, but we've had a lot of activity here over the last month to report on. First and foremost, taking a look at the production side for dairy. Milk production in the U.S., we had the latest milk production report for the month of June. And for that, we were looking at about 3.3% year-over-year growth. Keep in mind, that's just on the flow number. So that's a pretty significant jump higher year-over-year. When you look at all the data, there is some comp data from the last year. So if we look at 2024 data, we could say, well, some of that was hampered because of bird flu in some regions, and that's why we're seeing such a big growth. But I think the big notable thing to think about in this is when you also look at the component tests in milk, those are through the roof. You look at milk fat on an average basis going back, it's been what a lot of people have been calling like a hockey stick effect, where we really slammed on the gas in terms of being able to crank out additional components. So when we see 3.3% of a headline growth year over year, keep in mind that that number from a component basis is even greater. And it's also interesting to think back. I know this has been a situation we've been monitoring closely because talking with producers and looking at markets, and especially when you look at auction prices for replacement dairy animals over the last year and a half, they've been at some crazy high price levels. So the expectation is that there wasn't any heifers out there. The USDA's cattle inventory report that we only see once or twice a year was supporting that as well. But interestingly enough, we continue to see this growth in milk production, particularly in regions that are important for the new processing capacity that's coming online and such. We're going to have another milk production report coming out for this Thursday. That'll be the July 2025 report. I think for that, we're forecasting, again, the potential for about a 3% year-over-year growth in milk production here in the U.S. So been very impressive. I mean, you got to tip your cap to those out there that are experts in the genetic space and what they've been able to do with these animals in terms of longevity, component output, all those sorts of things. It's been an interesting run from a production perspective here, despite what maybe the headlines were saying about cattle inventories.
Absolutely, Curtis. And that's exactly what I was thinking as you were going through that growth is just this is the manifestation of these years of genetic improvement, cow comfort, and doing so many things right that we as a nation and that milk production level can continue to grow despite factors that in the past we would have predicted would have started to possibly bring that down. But kudos to our producers for doing things right and to the industry for investing in the ability for these cows to keep making milk the way that they are, huh?
Absolutely. It's been quite an interesting run there. I think keeping on the production side of the equation, another thing to note of that's been important here for markets as of late was last week we had the August World Agricultural Supply and Demand Estimate report, so the WASDE report. We already kind of knew going into this report that we had put a lot of corn acreage in and that weather has been cooperating and we should have a big crop. I heard the saying going around the industry for a while that in the August WASDE report, big crops get bigger. And that was absolutely true in this case. USDA put out a number. I think a lot of analyst estimates were in this 184, 185 bushel per acre average for the U.S. kind of expectation level. And USDA gave us a 188. So that was quite a significant number. They also took 2 million acres away from soybeans and shifted it over to corn. So we already knew that we were going to plant a lot of corn acres earlier this year. So that's another little cherry on top of the balance sheet there. With that, we're expecting a record crop. So this will be the biggest corn crop on record of 16.7 billion bushels. It's crazy to say that out loud, and that could be a reality, but maybe it's weather, maybe it's genetics and seeds. Impressive that we've been able to crank out that much. As a market reaction to that, we quickly saw within seconds of that report release, new crop corn futures have plummeted to new contract lows. So we're sub $4 per bushel corn in a lot of those months going out now. And that's been advantageous for dairy producers, particularly when we're looking at margins and kind of building expectations around things. But yeah, been quite interesting. And then on the protein side of things, sticking with feed, looking at the soybean meal complex. So that one's been a little bit more supported here as of late. We haven't seen as much downward pressure there. I mentioned that some acreage was taken away from soybeans to corn on that WASDE report. Not really any big shockers on the balance sheet for the soy complex there. But the big thing is trade negotiations. And we've seen a lot of things popping up on Twitter and headlines about the potential of China coming back to the table. President Trump specifically calling out soybeans and calling for about a 4x purchase of quantities of soybeans coming out of the US. That headline expectation has caused a little bit of temporary support to that soybean market. All in all, I think the longer term fundamental trends are in place that we're still going to have a pretty large crop coming out for soybeans as well. And we've made significant investments in domestic crushing capacity. So exports may be a little bit of an uphill struggle. Maybe there's some surprises in the works of if there are some trade deals to come together, but net there still is some pressure there on the downside. So going from looking at this corn crop, looking at soybean meal and all these things, it's putting dairy producers in a very good position for looking at feed costs into the future. But I'm always quick to remind people of, like, when you look at futures markets, they are trading off of the expectations of these crops. We have not harvested these crops yet, so this is all based on the expectation of what could be there, and that drives the price direction. And there's managed money funds and all sorts of other market participants that are in those markets moving things on a daily basis. But in the long run, the reality is once we start harvesting this crop and once we actually see what's out there, things could change. So I mean, maybe the crop's bigger than we expected, or maybe it's smaller. And as we get into that reality and work through some of those logistics, markets will also start to react to some of that information. So you've probably heard me say this a million times, but always preaching proactivity, because when we are looking at opportunities to buy in feed and position ourselves in a way to take advantage of these things, then that's great. There are lots of flexible options of ways to do that, whether that's through a cash forward contract or using call options or futures contracts to essentially lock in some of that price on some of those feed ingredients. But at the end of the day, I mean, we're in this market and the market is giving us a very good opportunity on the feed side here looking forward.
Curtis, just to back that up, I mean, you've been stating this, but largest corn crop on record, and opportunities to be able to lock in on some advantages of that as a dairy producer. And I will vouch for how things look here in Northeast Wisconsin. If you are someone who takes pride in growing a good crop of corn and taking the tallest stalk of corn to the county fair, like, you are winning right now. But I just did a trip over to Northwest Iowa a few weeks ago, and same thing. I think any farmer or anyone who's got farming in their blood, when they see a beautiful crop of corn, it just makes your day. You have that pride in what's going on in the ag community. However, with that comes the reality that this huge crop of corn, biggest on record, means that lower price point, advantageous for our dairy farmers, not so much for our crop farmers. But hey, let's take advantage of what's out there. How are things looking in your part of the country?
Well, I may not have had as exciting of a Uplevel crop tour. I'm here in the Central Valley of California, so it's all irrigated, flat corn, but I have heard from a couple of local producers that have gotten in early. We haven't really kicked off most of our harvest yet, but some people have pulled off some early corn, and they've said yields are absolutely spectacular. So we've had I would say, somewhat mild summer here in the Central Valley of California, where it hasn't been super hot. That being said, we have a 107 in the forecast coming up in the next couple days here. So I kind of say that a little bit tongue-in-cheek, I guess I would say. But from a crop and forage availability standpoint, everybody's in a pretty good position here.
What about corn? So if we've got the largest corn crop on record and it's more than our domestic needs, what are we doing with the rest of it?
From an export position on corn, we don't export as much, at least historically, as we do in terms of beans, in terms of our amount of production or amount of exports that make up that demand portion of the balance sheet. Mexico tends to be our biggest partner there in terms of exports. And they've actually, so this year, this crop marketing year for 24-25, which will expire at the end of August here, September, that will be one of the best export years because we've been sending a lot of corn to Mexico. I mean, the situation with trying to rebuild the North American cattle herd has brought a lot of demand to bring corn across the border and such. And with that, I would say somewhat supportive to that and actually tightened up the old crop balance sheet. So from last year's crop and inventories kind of left over, things are still relatively tight. We're talking about this big crop that's going to be harvested, but the old crop inventories are not as bountiful as what's coming down the pipeline. And some of that, when you're looking at getting cash contracts for the dairy to bring in corn, is impacting basis markets as well, because right now, because there's not ample supplies at the elevator or at the mills, we're seeing a little bit of elevated basis levels where corn won't be moving around as much. But as we get into the fields, if we do have this big harvest that is realized, then we would expect basis levels to start to soften up a little bit, which would then provide more of an advantage to the producer if there's a lower basis price and a good futures price to be able to get those cash contracts locked in.
So what else has been going on in the markets, Curtis?
Shifting over to the revenue side a little bit, we'll talk cattle. I think cattle is another important one. Obviously, the last year that becoming a more and more significant piece of income on the dairy farm. Cattle markets have been, again, on a tear. We make new record highs, it seems like every couple of days. We have had a couple of events here where in the feeder cattle market, we get to a certain point, we run into resistance and the price moves lower. And I think there is still longer term support there with the lack of inventory of cattle that are out there. We really have to rewind the clocks to tell the story of what's going on in that market and what could be happening now as we are attempting to rebuild this herd. Because ultimately we look back to right around 2022 when we had a lot of drought across the US. Things were a lot more expensive from a feed side of things, of buying in feed. And if you are a cow-calf producer and you have cows out on pasture and there is no pasture growth and you have to buy in feed at expensive levels, it looks a lot more attractive to just send those heifers to the feedlot and make it someone else's problem. And that's what happened. And that's why we got ourselves in this situation to where now we don't have the herd inventory in the US to sustain what's out there from a demand perspective. And that's why we're getting to these record high price levels. But we talked about how feed is becoming more affordable for dairy producers. It's also becoming more affordable for the cattle ranchers out there. And this drought situation for those cow-calf operators that are out there on the pasture growth is a much better situation right now as well. So with that, I would imagine, and I think it's difficult because we don't get a lot of publicly available data on this. We're just operating off of chatter we hear from different people in the markets. But there is a pretty great deal of heifer retention taking place, people breeding back to rebuild that herd back in. And since we don't get a lot of information other than what's happening at auctions across the US that are feeding into that feeder cattle index and such, we're limited on information. But it's one of those things that once we get the supply back and we're at a balance point, it could be a pretty significant reset in that market. Now, timing exactly when that's going to happen is a fool's errand because we're never going to be able to know exactly at what day we're going to have enough supply to perfectly match up or even exceed what's out there from a demand perspective. But I think you look at that market, and every time that we make a new high and we start to sell off a little bit, the downward move is very aggressive because everybody that is open on any risk to the downside, if they think this thing is falling, they want to catch the falling knife and really ride it all the way down. So I don't know that we're necessarily at a point yet where we're going to make that sort of a capitulation move to the downside. But when we do, it could be pretty significant. So again, referencing back to, I know we had talked about some of the options available to dairy producers now to secure the value of these beef on dairy calves. That program has been a great tool for producers to mitigate some of that risk, particularly because it's become a more significant portion of your income statement. Used to be something that wasn't that big of a deal. Now it's adding upwards of $2 or $3 or even more dollars per hundredweight to the overall equation for how we look at that sort of income.
Curtis, let's switch gears to hear what's going on in our key dairy commodity markets.
So going through kind of our core four commodities that make up all of our milk pricing, on the cheese side of things, we have seen a little bit of support here as of late. We went down where block cheese in the cash market was hanging in that mid to low 160 range. We came out of there, got close to about 190 into the upper 180s. We saw a little bit of a reset late last week, dropping back down to the mid 170s. And then again, early this week, we're actually in quite a supportive thing back into the 180s once again. I think seasonally where we're at, it's mid-August. A lot of schools are starting to get back in session. That starts to pull on some class 1 demand for the school milk program. From a pricing perspective, even in that 170, 180 price range for cheese, that is a favorable price range from the export market. A lot of the other commodity style cheeses around the world are pricing in at a significantly higher price point. So the U.S. has been having an amazing year in terms of cheese exports. And I think with all those factors combined, I don't necessarily see anything in 2025 that seems to be a glaring red flag that, hey, we're about to step off a cliff here a little bit. But I do think it's important. We talked about milk production, the overall output being up, not only on just a flow basis, but also on the individual component levels. And ultimately, those components are what gets made into these commodities. If we think about all the new processing capacity for cheese, we're talking about a significant amount of additional cheese production that has been coming online. If we were to catch a little bit of a misstep where demand does slow down, so domestic demand's been holding steady for cheese. Export demand, as I mentioned, is through the roof right now because of our price competitiveness. But we're in this window now where things are good. But get into October, November timeframe this year, once we're past the holiday purchasing window, the market has rebalanced because the new class 1 demand from school milk has been absorbed. I think we could be having a little bit of a different tone here. I think we're currently set up in a fashion where supply could very easily outpace demand from a cheese perspective. That's not me saying that, oh man, this thing's going to totally fall apart. But if we even break out of this 170, 180 price range and we get down to a 155, 160 price point for cheese, which is entirely probable for some point in the first half of 2026, if we put in weigh values where they're currently at, that gets us a class 3 milk price that's right around $16. So right now, we're looking at class 3 futures at upper 17s for the first half of 2026. But if we are to see that reset of not a huge movement in the market, but enough, that would change the outlook significantly. So that's been something to monitor here very closely because we're in good standing right now, I would say, for the healthy cheese balance sheet. But if you change a few variables, that could change the price range that we're trading in very, very quickly. And then we shift over to butter. Butter makes up a pretty big chunk of everybody's milk check as well, particularly when we're cranking out these crazy high fat levels. That market's been a bit of a struggle. We've seen in the past couple years these big bull runs, particularly starting out in the spring and then getting into that September, October timeframe when we're peaking out and we're getting to those $3, $3.50 type levels. We were really struggling to get any momentum this year. We got as high as about 265 briefly, and then now we're down to a cash market that's down into the 230s. Can we fall lower than 230? It's been a while since we've been lower than that, but when you look at from a production standpoint, again, we're cranking out a lot of butter. We're cranking out a lot of butter fat to make that butter, and it's been keeping a lot of pressure on that market. I still think there is some underlying support in that market at a certain point, whether that's at 225 or 220, just because we all know now, especially with the current administration and the precedent set that dairy fats and particularly butter fat being a healthier alternative to seed oils, a lot of brands out there and a lot of food service chains are not going to replace that, especially at these lower price points. We're somewhat competitive there. Exports have been making up some of the slack on the butter side of things, but again, whenever we're looking at cheese and butter, we export very little, so we're always happy to get the export business that we can, but it's not a significant portion of the overall demand picture. And then lastly, just rolling together the powders, so dry whey and non-fat dry milk. Dry whey has, again, still we're seeing that longer term demand trend. I feel like I see a new article every week about GLP-1 and everybody eating these healthy dairy proteins. That's not going away anytime soon. So that's been, I would say, a little bit of a bright spot. It doesn't add a ton of value to milk checks in terms of that whey value, but it's nice to see people promoting dairy proteins in a positive way out there to the rest of the world. And again, right now with all this additional cheese processing capacity as a byproduct, we're getting whey, more and more of that whey starting to climb that value stream into those higher protein concentrates that are going to be ending up in consumer products around the world. So that's been, I would say, a market that I don't expect to see a lot of downside in just because of that sort of insatiable demand for those higher protein whey products. And then on the non-fat dry milk, skim milk powder side of things, that market's been a bit more of a challenge. So I think we've talked a little bit about the counterbalance of as we export more cheese, particularly to customers that are like in Mexico being a large buyer of that cheese, they would otherwise be buying our milk powders to be making cheese domestically. So as they buy more of our cheese in, we export less powder going out. And I know a lot of manufacturers, large manufacturers on the milk powder side of things have been trying to climb that value chain into NPCs and non-commodity things. So we've been seeing production kind of move lower for non-fat dry milk for some time now, but stocks continue to back up. So that market is probably the most tradable. And when you look at where we price our product versus the rest of the world, we typically stay pretty well in line. So something in that mid to low 120-ish range is likely here to stay for a while. So you take those two things together with the pressure on the fat market for those dairy producers that are in a more class 4 heavy region, could see a little bit of downside there. I think we're forecasting prices to come off a little bit for class 4, not quite as drastic as I think we'll see for class 3, but still something to be aware of.
Let's tie all this together because you and your team have been spending a significant amount of time recently looking at how all of these pieces come together to create a forecast looking ahead. So give us an update. What's going on there and what should be top of mind for dairy producers right now?
Yeah, so we touched on bits and pieces of this kind of through this conversation, but I think holistically when thinking about this from the dairy producer's perspective, at the end of the day, what is our goal? I've probably said this to you many times, and I'll say it again, but the dairy business itself, the core of the business, is a commodity manufacturing business where we're intaking feed, we're converting it into milk with a byproduct of beef. So when we look at sort of those three elements of the big key variable factors that make up the profit and loss at the bottom of our income statement, right now, looking ahead, those numbers are quite favorable for 2026. They're not quite as good as they were in 2024. I'm not going to lie to anyone and say, oh man, we're going to be as good as we were in 2024. But when we look at things holistically, 2024 was a very good year. 2025 has been a pretty good year, and things are improving with milk prices hanging around, cheese in that 170, 180 range. We're happy about the big crop that's coming out from a corn perspective. 2026 is going to be looking like right now, at least with the cards that were being dealt from a margin projection standpoint, a pretty decent year as well. And I think when we zoom out and we measure our success over a longer time horizon as a producer, especially when we talk about this business being a legacy business, so I think it's always our duty to zoom out and take a step back. There aren't many time frames where we've had 3 years of consistent profitability as dairy farmers. And because we're being dealt that, I think that's one thing right now, particularly with the potential of the cheese side, we'll pick on that. But on the cheese side, if production is to outpace demand because we built all these class 3 plants very quickly and we got all the milk in them very quickly, that is something that could take away a pretty significant chunk of that margin for dairy producers in 2026 if we are to lose some of that demand and that price is to drop down to that 160, 150-ish range. So again, just looking holistically at those three things, the feed side, like right now, it's great. We're at some of these contract lows. We're going to have this massive corn crop. Looking at the beef side, feeder cattle continue to make new highs. Everyone's excited about selling those day-old calves. There are tools that we can now use to set price floors on that stuff as well, kind of referencing back to our previous conversations about the LRP products there. And then on the milk side, when you look out to 2026, maybe right now, it's not the prettiest. It's hard to get really excited about milk in the mid to upper $17 range. But when we look holistically at the margin, the opportunity's there. We're being dealt a pretty good hand. And again, we have to make sure we're measuring our success over a much longer time horizon so that we can set our expectations and put together a plan where we can capture these things on a consistent basis.
Excellent, Curtis. And as always, for producers that are looking for help with putting together that plan, you and your team are just a phone call away at HighGround Dairy, and we'll include a link for your contact information in the show notes, as well as your monthly market report from HighGround. And Curtis, anything else you'd like to add as we recap August here on Uplevel Dairy?
I think we're in pretty good shape. Obviously, a little bit of a call to action here of, I think we're in this window of time. It's mid-August now. We're going to see a little bit of support waves kicking up in the next month or two, which could be helpful to that 2026 picture as we're looking ahead. But if you're a producer right now that doesn't have a plan of attack of how we're going to go about managing our margins in 2026, this is a very good time to get started and to get thinking about it, because we're in a situation now where we can play some offense. We're not playing defense yet, and we can capture some solid profitability for the year ahead.
Curtis, thanks for jumping on with us today for Uplevel Dairy Podcast, and there'll be links in our show notes so that our listeners can do exactly what you just instructed, and that's to pay attention to the market signals and that call to action to protect their margin and have that long-term view over profitability for not just this year, but the years to come. Thanks for joining us today, Curtis. You just heard from Curtis Bosma with HighGround Dairy here on the Uplevel Dairy Podcast. I'm your host, Peggy Coffeen. Thanks again for listening, and until next time, keep on growing, keep on learning, and up-leveling your dairy.